This video looks at consolidation with an asset revaluation 2 years after acquisition, where there is goodwill on acquisition. The example taken here is on 1st of July 20XO, Michael, an investor, acquired 100% of Samuel's business ownership for $500 million. At the date of acquisition, Samuel's business had $200 million of share capital, $280 million of retained earnings, together equals $480 million, and the machinery cost was $533 million, and accumulated depreciation was $53 million. For 533 minus 53 equals the carrying value of 480 that represents the shareholders' equity. Michael determined that the subsidiary's fair value of the machinery was $490 million, with no change to its remaining useful life and no residual value. Michael had issued $500 million in share capital, which was used to purchase Samuel's business. The investing firm is Michael parent, and the invested firm is Michael's subsidiary. Michael parent and Michael's subsidiary provided the income statement and the balance sheet as of 1st July 20XO, date of acquisition, and at the end of 30th June 20X2, 2 years after. On 30th June 20X2, Michael parent determined that the goodwill on consolidation had suffered impairments of $2 million in the previous year and $3 million in the current year. The corporate tax rate is 30%, required on 30th June 20X2 show consolidation journal entries and to show Michael Group financial statements. So at the date of acquisition, Michael parent had invested $500 million, and that was raised through share capital. And this investment was used to acquire shareholders' equity, $280 of retained earnings, and $200 of share capital of previously Samuel's subsidiary, now it's Michael's subsidiary. The net assets are represented by the machinery, and it's 480, and the shareholders' equity is 480. It's at the beginning of the year, so there's no activity in the income statement. June 20X2, 2 years after, the financial statements are given. The parent, the share capital, and the investment is shown, and there's no activity in the income statement showing that Michael parent is a passive investor. Michael subsidiary, on the other hand, has actively operated and made profits. The machinery, which is the cost is 533, and the accumulated depreciation has become 159. We saw that at the date of acquisition, the accumulated depreciation was 53. And the cost of the machinery was 533. So 533.53. If we divide 533 by 53, what we get is 10. So there's 10 years of useful life of this machinery. So 53 into now 3, that is when it was acquired, 1 year of depreciation was there, and then now 2 years after acquisition. So together is 3 years equals 159. So there's cash being built up because of the operations in the previous current year and the previous year, and the net assets of the Marker subsidiary is 699.03 million, and it's represented by shareholders' equity of 699.03 million. Our first consolidation entry is to revalue the machinery. But before we revalue, the machinery has to be stated at the carrying value. Therefore, at the date of acquisition, accumulated depreciation is debited, and we credit that to the machinery account, so that the machinery is now stated at the carrying value. Then we revalue the machinery by $10 million by debiting machinery, and we credit revaluation surplus because it's an unrealized gain. We increase the carrying value of the asset by 10 million in relation to the tax base. Carrying value is higher. That is the taxable difference, and applying the tax rate gives us the deferred tax liability. Typically, we debit income tax expense, but because this is an unrealized gain, we debit that amount to revaluation surplus. So when we look at our revaluation surplus, what we see is that the revaluation surplus has a debit and a credit, and the net amount equals 7 million. So there should have been a revaluation surplus of Mica subsidiary of 7 million, but in this consolidation we created or we generated that revaluation surplus because it was not there. Our second entry is to eliminate the investment against the fair value of shareholders' equity in the subsidiary. So we credit investment in Mica subsidiary 500 million. We debit share capital, 100% was acquired, 200 million, and we debit retained earnings, 100% was acquired, 280 million, and 100% of revaluation was acquired, and that's 7 million. And the remaining amount was an investment made for an intangible that cannot be individually identified, and that's the goodwill on consolidation. Our third entry is to recognize the additional depreciation that has to be included in the group accounts because there has been revaluation. The revaluation amount was 10 million. The useful life of the asset is 10 years. So for a year, the depreciation expense that has not been included, that must be included because of the revaluation expense, is 1 million. But there was a previous year, and there should have been depreciation expense in the previous year, and that depreciation expense should be included in retained earnings. That's 1 million. For the 2 years, accumulated depreciation is 2 million. Because we increase the depreciation expense, we increase the expense, the profit will now decrease. The decrease in profit will decrease our income tax expense, and the tax effect of that is at 30% is 0.3. Similarly, in the previous year, when there was depreciation expense of the previous year, which decreased the retained earnings, that there would have been income tax expense of 0.3, the tax effect of that, and that should be credited to retained earnings. In a more detailed way, if you look at on the carrying value and tax base, on 1st of July 20XO, the carrying value was, after revaluation, was 490 and the tax base was 480. The difference between the two is the taxable difference of 10. Applying the tax rate, deferred tax liability is 3. That 3 of deferred tax liability was included in our first consolidation entry. The asset was depreciated over 10 years and depreciation expense is 49 under carrying value, and on the tax base it is 48. So the difference between the two is 1. That requires 1 additional depreciation expense, which we have done it for the current year and the previous year. The carrying value at the end of 20x1 is 441 and the tax base is 432, and the difference between the two is 9 taxable value. Applying the tax rate, deferred tax liability is 2.7. So there's a decrease of a deferred tax liability from XO year to X1 year is 0.3. From X1 to X2 year, again we depreciate the asset at 49 and 48 based on the initial carrying value and the tax base, and there is depreciation expense of 1, and that's what we have included as depreciation expense, and the previous depreciation expense is what we have included under retained earnings. And when we look at the carrying amount at X2 year is 392, tax base is 384. The difference is 8 taxable difference at 30% tax rate. It is 2.4. So there's a decrease in the deferred tax liability of 0.3. For the 2 years, the decrease in deferred tax liability is 0.6 because the asset has been used up and the carrying value progressively is reduced. The fourth consolidation entry is for goodwill impairment. We've been informed that the goodwill has impaired in the current period by 3 million and in the previous period by 2 million. So current period it's recognized in the income statement, but for the previous period that should be recognized the retained earnings as a decrease in retained earnings. And we create a new account called accumulated impairment of goodwill on consolidation for the consolidated financial statement, and we state the accumulated impairment of goodwill on consolidation as 5. Now we are in a position to enter our consolidation entries in the consolidation worksheet in the adjustment columns of debit and credit. We have the Michael parent and Michael subsidiary as at 20x2. Our first entry was to revalue the asset. We debited accumulated depreciation and we credited machinery as at the date of acquisition. Then we increased the machinery value by 10 and we increased the revaluation surplus by 10. Because we increased the machinery value, our carrying value is more than the tax base. That 10 is the taxable difference. So therefore, our deferred tax liability on that is 3. The debit for that is not income tax expense because it's unrealized gain. So we debit the revaluation surplus. There's also a revaluation surplus that we have. That revaluation surplus is now 7 credit. Our second entry is to eliminate the investment in subsidiary against the shareholders' equity that was acquired on that date in Michael subsidiary. So 500 we credit. We debit against share capital at the date of acquisition 200, and we debit against the retained earnings the date of acquisition 280. Although it has made 380, that is for the previous period, and also the retained earnings at the date of acquisition. We debit only 280 because that was the retained earnings at the date of acquisition. Once we have done that, there is a difference. And then we also debit the revaluation surplus 7 because that's part of shareholders' equity. And once we have done that, the remaining amount is an investment that Michael parent made for intangibles that cannot be individually recognized. That's the goodwill on consolidation. Our third journal entry relates to additional depreciation expenses because of the revaluation and the tax effect of that. So our additional depreciation expense was 1 million in the current period, 1 million in the current period, and 1 million in the previous period, and that's corresponded by 2 million of accumulated depreciation. So this 1 million of depreciation expense gives rise to income tax expense, a decrease of 0.3, and the previous year's 1 million depreciation expense, which is in the retained profits. So that 0.3 is here, and in the previous year's retained profits was 1 million we debited, and for that depreciation expense, there's income tax expense reduction of 0.3. That's in retained profits of the prior period. So that's our third journal entry. And then our fourth journal entry And our third journal entry of deferred tax liability is 0.6, because this income tax expense of 0.3 and this 0.3 of the previous period and the current period, and they are being credited here, and that's going to decrease the deferred tax liabilities for 2 years, and that's 0.6. The deferred tax liability decreases. Our initial deferred tax liability was 3. It progressively decreases by 0.3 every year because the useful life of the asset is 10 years. So every year 0.3 it decreases. For 2 years it's 0.6. Decreases because the carrying value of the asset progressively decreases. And our fourth entry relates to goodwill impairment. In the current period, goodwill has impaired by 3 million, and the previous period it has impaired by 2 million. And the accumulated impairment of goodwill is 5 million. It's a newly created account for the group financial statement. So if you look at the group financial statement, we can see that there is goodwill on acquisition, a new asset that was previously included in the investment, as now it has become transparent. And then we got the machinery. The revalued amount is 490 because we revalued the machinery, the carrying value, from 480 to 490, and then it has its accumulated depreciation for 3 years, and that is shown there. And there's cash surplus because the subsidiary was making profits. And then there's deferred tax liability, but the deferred tax liability from its original value, it has decreased. So as a result, our net assets is now 712.63. And our share capital, the group share capital, because we eliminated the share capital of the subsidiary, because the parent, Michael parent acquired 100% of interest in Michael's subsidiary, and therefore that share capital investment was eliminated through the elimination of investment entry. And therefore what is shown here is Michael parent's share capital. The revaluation surplus of the subsidiary is completely eliminated in the elimination entry. Retained earnings in the prior period, we eliminated the acquisition date amount, but then there is a previous post-acquisition year, and the amount that's remaining in the subsidiary after adjustments is in the group. So similarly, retained earnings in the current period after adjustments remains in the group. And our shareholders' equity is 712.63, and that is represented by the net assets of 712.63. In the income statement, Michael had no activity on 20x2. Michael's subsidiary had activity and made profit. In the income statement, there was depreciation expense of 1 that was included in the current period, and the income tax decrease of 0.3 because of this expense. And there was other expenses of goodwill impairment, 3 million. So that's included. Therefore, the group profit after tax became 115.3. That 115.3 is now included in the balance sheet for the current period. That brings us to the end of the video. Thanks for watching.